session is called Value Creation in Clubs. It's clearly a large topic. It's not a topic that you can really fully cover in an hour, but we're going to start digging into it a little bit. And it's one of those funny areas. I mean, every club in the country has the opportunity to be a club focused on value creation. And as folks that have gone around and seen, hundreds and hundreds of clubs, we can tell you that there are some clubs that are squarely focused on value creation. And by that, I mean from a member's perspective, and clubs that frankly are not focused on value creation and are focused on other things, which we'll talk about. And so what we're trying to do today is talk about what do the clubs look like, how do they act and behave that are focused on value creation, and maybe what do the clubs look like that aren't so focused on that, or maybe don't even have the opportunity to focus on that because they don't have the environment set up either financially or culturally to go down that more prosperous path. But it really is an intersection of finance, of culture, of a whole bunch of loyalty. We're not even going to get into that, but we're starting to dig deep into the whole world of member loyalty, which is different than member satisfaction. You can have satisfied members that aren't loyal. So there's a whole another realm that you'll be hearing more about from us in that vein. But we're going to focus mainly on kind of the financial and cultural aspects of it a little bit. And I think the goal for today is that everyone, after they leave this session, can kind of openly, honestly ask themselves the question, are we a club that's focused on value creation? And if you are, then the next question obviously is how do we stay there? Recognizing we're there, and how do we stay there? And if you're not, recognizing you're not and saying, geez, how do we get off this path we're on and maybe become more value oriented? And that obviously pays dividends for the club, financial health of the club, and the members down the road. So we're going to dig into a little bit of all that. It's really ultimately, when I think about long-term value creation, it really answers the question, how do we stay relevant going forward? And of course, that's a moving target because relevancy changes with what your current and future members perceive as value. And, again, it's about setting up the environment to enable the club to be flexible enough to do that over time. So anyway, that's kind of a long preamble, but that's sort of where we're headed. And as always, everything we're looking at today is the result of us, digging through thousands of clubs of data and visiting literally with hundreds of clubs over the last number of years and pulling and doing what we call pattern recognition, right? Looking for the things that work and the things that don't work, and trying to make everybody a little bit smarter by exposing both of those, not just one of those, but both of those. So, value creation clubs, what is it? What are we actually talking about? What does it mean? Can we actually measure it? Are there ways to measure it? I think there are two aspects to measurement I alluded to a second ago. One is around the notion of loyalty and satisfaction, and the other is the notion around measuring it financially. And we're going to sway a little bit on the financial side today just because we haven't gone down that loyalty path yet. But ultimately, the more important thing is how do you get there and how do you stay there? And I think there are some themes that we're going to talk about in the session that I think should be front and center in every boardroom of every club, and they're probably not. We know why, in most cases, but these themes I think are important. I think they do apply to every club, whether it's a tiny $2 million club or a $25 million club. I think the same themes around ongoing value creation apply, and hopefully that's what we're going to expose a little bit today. A couple starting thoughts, just to kind of set a baseline for all of us is, we're big believers. I think most people would probably agree with this, but we're big believers that a club's initiation fee is an excellent proxy for probably what it thinks about its own member value proposition. It is kind of the ultimate gauge of whether you feel like you've got a high value club, a low value club, a mid value club. I mean, we all know there's if you're a club that is positioning yourself in the marketplace with a zero initiation fee, that's a very different position than a club that's positioning itself with a $50,000 initiation fee. You not only are you're clearly you're going after different members, but you're conveying a very different message about the expectations that the member should see or should expect, I guess, when they come into the club. And you know, in some cases, you know, initiation fee, it's an interesting chicken and the egg on that. I mean, sometimes folks set the expectation because of their initiation fee, and other times the initiation fee is set through circumstances of expectation. That's kind of complicated, but it's a very important aspect that I don't think actually catches enough attention. So anyway, that's a notion we have going through this, and one that I think every club and every boardroom should have front and center. We're going to talk about the notion of capital rich and capital starved and how that impacts a club's ability to be focused on value creation or not, and it's vitally important. The thing about my view of value creation, it is very forward-looking. It's something that you need to be thinking about all the time. You obviously can't act on it every day, but you know, creating value for members should be thought about every day and certainly discussed in every boardroom. And you know, I'm not really here talking about things of, oh, do we have this party or that party, right? I'm talking about the big moves, the big chess piece moves that move the club down the road and say, yes, we are staying relevant because we're investing in this or that, and we believe that has high member value. So it is forward-looking, and it's ongoing, and it never stops. And it's highly cultural. You can have a membership with a culture that is expects ongoing value improvements, you know, every year, every other year. And you can have clubs and memberships that frankly, you know, are stuck in this world of we don't want anything to change, and they're not, you know, they're not value oriented. They're locked in the way it used to be, right? They're looking backward. They're not looking forward. And the whole notion of value creation is looking forward, and you can impact the culture of the club by investing in the right things and presenting, you know, value in new ways. It'll become self-evident as we go through this a little bit. But again, as we've looked at hundreds and hundreds of clubs, I'm going to bookend this to make it obvious. But there's a clear, we know within 10 minutes of either talking to people at a club or looking at the data, even more importantly, we can tell within 10 minutes whether that's a club that's oriented towards the value creation culture or oriented towards the cost cutting or cost control culture. And there's a very common set of attributes that it's almost universal, and there is obviously gray in the middle, but you know, for the clubs that we see that are highly oriented towards value creation, and this is, you know, everyone on this call right now can kind of check the box on each one of these as we go through and see which side of this equation do we seem to be falling on. But you know, what we tend to see is a very strong dues engine, meaning that their member counts and the dollars they get, the dues dollars they get per member, creates what we call the dues engine, a very healthy dues engine. They're either at the median for the dues ratio or typically above. The more above obviously gives you more flexibility, but it's a very strong dues engine. It's capital rich. That's somewhat, you know, intuitive, but the capital that they produce that's available to actually reinvest back in the club is in a category that we would call them capital rich. This is a little more tactical in nature, but it is absolutely an attribute that follows through. F&B is treated as an amenity, no different than golf, tennis, fitness, you know, all those kinds of things are treated as amenities. And these value-oriented clubs, they tend to have, you know, far deeper subsidies into food and beverage, and you don't hear things like, you know, how do we make money in food and beverage? You just don't in a true value-oriented club. There's rising expectations. You know, there's a view from the membership that the experiences we have and the relationships we have in this club are going to only improve over time, right? It's always it's the kind of the light on the hill sort of thing. It's looking forward. It's focusing on the future. You know, these clubs often get themselves in a cycle where every few years there's a major new enhancement or investment coming up. We're going to talk about that a little bit more. You know, obviously cost efficiency, that's sort of, you know, motherhood and apple pie, but a very important one, which I didn't have on this chart, I put it on this morning because I think it's very relevant, is there's a balance sheet focus. We're going to talk a lot about that as we go through the rest of the session, but the board, not so much the management of the club, because we know the management should be tending to focus on operations, but the board for these clubs is very focused on balance sheet. Just like any company in any industry, the health of a company is measured more by the balance sheet than it is by the income statement. You can have a great year and a lousy balance sheet, and a terrible year and a lousy balance sheet, or vice versa. And it's the balance sheet that actually allows you to invest more, so that you tend to not have the lousy years. And that's where health is really defined. And so, we'll talk a little bit more about that. But on the flip side, the bookend of that, what do we tend to see? It's obviously sort of the opposite of all the things I just talked about. It's a weak dues engine, typically because they've had a dwindling membership, which, by the way, goes hand in hand with a club that is not oriented towards value creation, right? I mean, it's not surprising those clubs have higher turnover. But, weak dues either because their member counts are low, or because they've been afraid, because they don't have the confidence in their value, to ask for dues increases every year like the value-oriented clubs do. They're by nature capital starved, which means they're not able to reinvest back in themselves on a regular basis. We're going to talk a lot about that. They obviously tend to talk, these are the clubs that tend to talk about F&B as a profit center. They're very focused on banquets. They're focused on cost of food. They're focused on all these things that really don't have bottom line impact, but they feel as though they're in their control. And so they focus on those things because they tend to be the things that they can, turn the knob on, even though they don't really have any impact. In fact, often clubs that are driving F&B as a profit center, they're actually going against the value creation because you're delivering a lesser experience to your members. So it's part and parcel of that whole mindset. It's diminishing expectations. It's how much can we cut back and still keep members just happy enough. It's not a great environment to be in. Staff is often stressed because they're overworked and understaffed, and it does impact the membership certainly over time. The focus is on the present, meaning how do we pay the bills next month? They're not thinking 2 or 3 years down the road. They're thinking tactically, not strategically. And it's where the board, a lot of the folks on this call, they've been in clubs for a long time. We all know the boards that are too deep into the income statement and they don't even look at the balance sheet hardly. And that income statement orientation is absolutely, right, they're worried about the bottom line of 1 year, right? A balance sheet tells you what has happened financially to this club over a long period of time. An income statement tells you what's happened financially in this club over a very short period of time. Obviously, if you're focused on long-term value, you should have a long-term financial aspect, not focused on that, you have a short-term. So these are the patterns we see. And at most clubs, a lot of clubs fit in the middle somewhere, but you can, everyone has the windage. They know where they fit on one side or the other. One of the important theses we came up with, this is a couple months back, we really said, how do we really try to expose the behaviors of clubs that are hitting it out of the park versus the clubs that aren't? And so we kind of discovered, if you will, that there are these cycles, 2 different cycles that clubs tend to fall into. Again, there's gray in the middle, but to help you really understand it, you've got what we call a growth cycle and a decay cycle. So let's talk about the growth cycle first, because that's the healthy one. Generally, it's the clubs that understand and over long periods of time have viewed increased capital investment as a driver of demand and of ongoing capital income. So how do these clubs behave in this 2 to 3 year cycle, whatever cycle they're in of significant investment? Right, their view is, what are the things that we can invest in that members would perceive as high value? Right, that's the important starting question that every board should have. And so the goal of that is broader amenities and facilities. The goal of all this capital investment, frankly, is like in any business, it's to increase demand, right? There's a certain supply in the marketplace of club memberships. You're trying to increase demand for what you offer. And so that increased demand reflects itself in increased, current member loyalty and satisfaction, as well as, establishing that waiting list. You've got more people that want to join the club, and in fact, because of the investment the club makes on a regular basis, they're willing to pay a higher initiation fee. So the investment drives demand, higher initiation fees, and more members. That, in effect, creates the return on investment. We'll talk about that more, but it gives you increased amounts of capital income, whether it's because you have more members paying capital dues or more new members paying higher initiation fees. That gives you that higher return on investment, and that you keep going around that wheel, right? More wise investment drives demand, which drives more capital income, which drives more ability to invest. And you get on that wheel, and I apologize for spending time on this, but it really is critical. The decay cycle is really just the opposite. It's the ones that they're stuck, right? And you can't, it's very hard, you can, but it's very hard to move from one to the other. But these are clubs that are stuck in, they're by and large capital starved. They have restricted capital investment. Obviously, we all know I know when we drive onto a club, we know within a few minutes whether that's frankly a club that's capital rich or capital starved. You can tell by looking at the parking lot, right? Are there potholes in the parking lot? Does it need repaving? Are the carpets worn out when you walk in the front door? Is the front door all scratched up? All these little things which are indicative of, bigger problems. These are little leaks in the big ship that catch up over time. So, it's that diminishing expectations in facilities, that makes it harder to attract new members. It certainly puts you in a mode where, well, we can't get more people, so what do? Well, let's lower the initiation fee, right? That's a really bad pattern that happens in clubs, thinking that a lower initiation fee is going to drive demand. It never really works out that way. We've yet to find a club who said, oh yeah, we had 10 members last year, so we cut our initiation fee. Well, how many members did you get this year? 10, right? But all you did was cut your initiation fees. And by lowering your initiation fees, you actually bring in members with lower expectations who are less likely to want to, pay more capital dues and assessments and those kind of things. So I think you get it. The key here is that for clubs that are stuck in this mode, the only way out of it is to, make that bold move, that bold investment. I call this the on-ramp into the growth cycle, this increased capital investment. And sometimes you only have one bullet you can fire, and you better aim wisely. But one way in any business, it's called investing your way to health. You can't cut your way to health. There's no amount of cutting you can do in the decay cycle. All of a sudden you say, you know what, we finally cut our way to health, so now we can invest, right? It's never going to work. It doesn't work that way in clubs. It doesn't work that way in any business. So I'm gonna blast through this very quickly, but return on investment. Everyone that's followed us has known that we take a very, I guess I'd call it classic business analysis approach to clubs. When we came into this, we didn't buy into the whole, yeah, but clubs are different. And in fact, when as we've analyzed clubs over the last number of years, they're not different. They're like any business. You have revenue. That revenue has to produce enough margin to fund your operating expenses. You either have a surplus or a deficit or break even on operations, and then at the end of the year you have some amount of capital to reinvest back in the club or pay down debt. It's just like any business, and so we look at it in that classic sense. I'm going to blow through this, but return on investment, going back to that wheel, is just the notion of hey, we're going to invest in this new facility, new fitness center, whatever it might be. The return on investment would be the discussion around, or the realization of, greater capital income as a result of that investment, right? Clubs hover around break even. The healthiest clubs in the industry, they don't make more money operationally. They break even. They have more capital as a result. That's kind of the profit or the return. And so that's what you're looking for, is that return on investment. We'll blow through that. To measure at the company level, I'm going to step through this quickly, but in the Wall Street world, one of the classic measures for measuring the value creation of a business is called return on equity. It's basically the profit that it was generated in a year over in proportion to the amount of owner's equity or owner's capital that's invested in that business. In the club world, it's a little bit different. It's called, we'll get to it in a minute, but the terms are a little bit different. But the notion is the same. The profit we're going to call capital income because that's the result of Y's investment is greater capital income. And the equity is the unrestricted net assets or a member's equity, we could call it. And if you look at most industries, you know, in differing industries, you'll see there are very different returns on equity expectations. In the high-tech world, right, high risk demands high reward. So you've got, you know, high amounts of ROE expected there. In the basic material world, you know, copper, iron ore, those kind of things, there's not a lot of risk. It basically just goes with the way the economy goes. Economy's up, basic materials are up, economy's down, low demand for basic materials. And so those have low expectations return on equity. We're actually going to look at what is the value equation for and the result for the club world. And I know I'm maybe straying a little bit away from the notion of, you know, value creation in a club, but this is the way to measure. If we actually want a financial measure of is this club returning value on its capital investment, this is how we'll measure it. And we'll see what it looks like. We're going to, in about 10 slides or so, we're going to see what the ROE is for the club industry, and I think you'll find it very interesting. You know, just quickly, as I said, the return on investment in clubs is measured by increased capital income. That's a key thing to recall, and just a very quick story about a club that, you know, didn't quite get that right. And I think this does happen to a number of clubs. We were at a club a year ago or so, and it's just a very telling story, so I'll tell this one. Obviously, I won't say what club it was, but they had been somewhat capital starved and decided they were going to make a bold move, and they were going to make a significant investment for them, which was in the $5 to $6 million range. And when you went into the club, there were basically two main areas, as there are in a lot of clubs. There was the member area, the grill, where the members hang out, where, you know, they all come after golf, they all come on Friday, Saturday night for dinner. It's the real member focused center of the club. And then the banquet facility. And frankly, both of them looked quite tired, you know, really run down, really hadn't been done in probably 20 years or so. And so they had some outside help, and the outside help, you know, in this case, didn't do them any favors and told them, you know, what you should do is spend your money on the banquet facility, because that's going to drive in all this new, you know, banquet revenue. You know, they're thinking revenue, not margin, right? Side note, banquet revenue, and that's going to help, you know, pay for all kinds of things around the club. Well, you know, 5, 6 years later, they did that. And 5 years later, we all know how that turns out. It doesn't really produce the monies you need. And more importantly, that was an investment that really was not aligned with member value. It did not create member value. You might have had your kid's wedding there, and it was nicer to have a nicer banquet facility. But the day in, day out member usage, that did nothing to spur member value. So if you put $5 million into the banquet facility, and now you ask yourself the question, does that investment allow us to increase our initiation fee? That's kind of a pretty obvious no. If you had spent that over on the member side and made that big and beautiful, maybe put in some new area, outside dining, whatever it might have been, that members would have said, wow, this is fantastic. And then you ask yourself, is this going to allow us to increase our initiation fee? The answer probably would have been yes. So they were now in a mode where 5 years later they struggled, and they frankly had a membership that was pretty unhappy with, all right, that didn't work out. How do we now go back to the well and convince them that we're going to do the right thing this time? So it's very challenging. But that's a great test. If you're going to do a major investment, apply the question of, does this allow us to increase our initiation fee? I don't care if your initiation fee is $2,000 and you're going to go to $4,000, or it's $20,000 and you're going to go to $30,000, whatever it is it going to allow us to move up that value chain? And if the answer is yes, that's a good sign that there really is truly member value in that investment. If the answer is no, you might want to go back and think about that, because, you know, member value creation comes first. The ancillary stuff has to come second. And capital income, if you buy into the theory that capital income is the measure of whether your investments were oriented towards member value, if you buy into that thesis, and we do, then that's a very valid question to be asking, whenever you're making an investment. I'm going to go through this. I think people understand. We have just, our model is at the end of the year, the end of the day, if you will, we have this notion of net available capital. It's post-operations, post-capital income, and some other adjustments, but it truly is the amount of money that a club has to either reinvest back in itself as capital investment, or as debt reduction, or as putting away as cash reserves. And so the important notion here is for every club and for every board especially, because we run into a lot of boards that don't know if they're capital rich or capital starved, and how can you possibly understand what your opportunities around value creation are if you don't understand whether you're capital rich or capital starved. You have to know. And so, again, to bookend it, what we do is we take that net available capital number and we divide it by the operating revenue, and we just make a ratio out of it. And so, the average club, median club, about 11 or 12% capital ratio. What does that mean? If it were a $10 million club and you were right at the median, you would have produced about 1.1 or 1.2 million of net available capital to reinvest back in yourself. Capital rich obviously has higher ratio, and capital starved has a low ratio. And so now what we're doing is we're stepping through and looking at what are the attributes of clubs that have created the environment for increasing member value versus the clubs that are stuck in the environment of not being able to increase, and create member value. And knowing which one you're in is hugely important, because you have to know, are we great where we are, and how do we make sure we stay there, or how the heck do we get out of this place and move up this curve so we can start having a long-term viability here. So we just talked about that. So if I peel apart, if I look at this section of clubs and the starved clubs and the rich clubs, what do they look like? And it's very telling when you blow those sections up, right? The capital starved clubs, the median of those clubs has zero net available capital, and half of them actually have a negative ratio. What does that mean? That means they stole all their capital income and they still didn't pay all their operational bills. Very, very, very bad place to be. Capital rich clubs, of course, on the other side, the middle club has 20% of its revenue as a number available for capital investment. Let's try to figure out now, what are the attributes of the starved clubs versus the rich clubs, and let's figure out. I guess some of this will be somewhat intuitive, but it is important to know what the measures are you might look at to understand, how you move up or down the curve one way or the other. Not surprisingly, if you have more capital to invest, right? These clubs have more capital than these clubs. You actually invest more capital. So the capital-rich clubs invest twice as much as a percentage of their revenue as capital-starved clubs do. Not surprising, but if you think about this as year over year over year, that has a huge impact, right? You're investing twice as much as somebody else, and that's over a 5-year period. Those two, if they started in the same place and followed that path after 5 years, those two clubs look completely different. You would never likely say, oh, that these clubs are roughly in the same, same zone of value, right? Because one will have blown way past the other one. Obviously, initiation fee of capital-rich clubs is, nearly 3 times as great as capital-starved clubs. Not a surprise. The question is, how do you move yourself up that initiation fee curve? We've talked about that. That is the investment wheel. I firmly believe in that. You have to have targeted capital investment is the only way that you can move yourself up that initiation fee curve. It's possible you can have an area where all of a sudden the area is booming and there is just organically a lot more demand, but that's not typically the case. This is a very interesting thing in that you can think about your initiation fee as very predictive. It's not just an attribute, but it's a predictive number for what you might expect as a club. What I did here was I simply took the initiation fee as a percentage of what a full member pays in annual dues. So as a for instance, 25% of clubs, their initiation fee is less than 1 year of full member annual dues. That's a pretty low hurdle it's a pretty low hurdle in terms of culling the kind of members you get in, and it's also a very low number in terms of, you know, how much it might give you from a capital income perspective. Basically, if your initiation fee is you know, equal to half of what a member pays for a full year dues, there's not a whole lot of, you know, horsepower behind that amount of money coming in. On the flip side, you know, you've got clubs up here where their initiation fee is 6, 7, 8, 9 times what a full member pays in annual dues. That has a lot of horsepower to it. And again, you have to think about all these things not just in the span of a year, but year over year over year over year. The compounding effect of this is quite massive. And not to look at all these numbers, but just as two numbers that I think are, you can say which is the chicken and which is the egg, and there's a little bit of that does go on, but eventually you got to get off that, you know, off that bad path. But, you know, 10% turnover ratio of full members for these low ratio clubs, 3% turnover ratio, right? So these clubs are turning over their whole membership every 33 years. I mean, that's a long time. These clubs are turning over their membership every 10 years. Really hard to do. And when you think about the cultural impact, think about the legacy and the tenure of your members, and the you know, the comfort of your membership, seeing the same people, the same relationships over a long span of time, whereas this kind of club is that revolving door of memberships. They're in, they're out, they're in, they're out. Very, very different experience. But I do believe that, you know, it's predictive. If you've got a very low initiation fee, having a high member turnover is a pretty predictive result. We're going to blow through this, but one other note of, in terms of the attributes of clubs that have the ability to invest in member value is they have much more likelihood and raise much more from capital dues. So there's this ongoing capital income, right? So they've trained the membership that this is part of the cultural thing, that your capital obligation to this club doesn't end with your initiation fee. It starts with your initiation fee. And as we can see, you know, about 3/4 of capital-rich clubs have capital dues, and the median is around $600 or $700. About half of the capital-starved clubs have capital dues, and the annual median is about $120. When you again, the compounding effect of capital dues from a predictable capital income state is massive, and don't underestimate how that changes the board's perspective on thinking short-term versus thinking long-term. If you've been used to having $300,000 of capital income for the last 5 years, and you make a change where all of a sudden that club is going to have $700,000 of capital income a year because you put in the capital dues, that changes everything, right? It changes their view from what broke last year that we have to replace to, you know, how are we, you know, intentionally planning for end of life of assets, or you know, thinking about, you know, real investment in the club. Very important aspect of it. We're going to go through this real quick, and this is just the member turnover again. We already took a look at that. I don't want to take up too much time in this aspect because I do want to leave some time for questions. Interestingly, this is, you know, there's while we know the initiation fee, there is a differential of capital rich and capital starved clubs, and we know, we'll look in a minute at the return on equity or value return of capital rich versus capital starved clubs. To be a member, once you're in, from a dues perspective, there's really no difference between a capital rich and a capital starved club. So, you know, you've got basically a median of 7. This is a year-old chart, so it's probably up by a few $100, but, you know, about a $7,000 median dues, full member dues for capital rich, and about the same for capital starved clubs. So that's a very interesting aspect, and this is where member expectation and increasing, you know, growing the expectations of members, not diminishing them, has a big impact. Because If there are 5 clubs in the area, and you know, you're looking at joining a club and it's $7,000 to join each club, you know, it's a very different experience to join that $7,000 capital starved club than to join the $7,000 capital rich club. Now, granted, are you going to pay more to join the capital rich club? Yeah, there's no doubt about it, you are, but that's the reason they're capital rich. But it's just, I wanted to put this up because it doesn't necessarily fall into dues, right? They all tend to converge around break even, plus or minus. This is different. With the ability, the environment for creating member value does not manifest itself in increased dues. Okay, that's important to recognize. So just to sum up a couple things we've learned so far. Capital rich clubs invest a higher proportion of their money back into the club. Not surprising. They have more members, but they aren't more expensive to belong. They have higher initiation fees, higher initiation fee income, higher capital dues, and more overall capital income, and they have half the turnover. So I only kind of put this here as a list to say, you know, this is kind of the checkbox of these are the attributes that we want to have as a club, right? We have to figure out, and it's you know, I know often it's not the management and staff that can make the decisions to move from the decay cycle to the growth cycle. But I do believe it's in the purview of the management and staff to educate the board, to bring them the information they need, to whatever they have to do to get them to recognize it. And we're going to look at a few slides in a minute, which are really compelling, that I suggest everybody take a look at. We talked very quickly for a second about you know, unrestricted net assets. We use that term. We use the term members' equity. We use the term net worth. They all mean the same thing to us in this discussion, which is it's the current asset value of the club. It truly is, if you looked at, you know, not as a business because it's not a for-profit business, but just what's the asset value of the club. You know, ideally you want that to be growing over time, but it is the sum total invested at any one point in time. Obviously, as you bring new assets in, they depreciate over time, and so you're constantly bringing capital in to you know, shore up those assets that are depreciating and have to be replaced, and you know, that's a never-ending cycle. But what's key is that value, this member equity net worth value, it can grow over time and shrink over time. And that's a very, very telling view about whether your club is on that growth wheel or stuck on that decay wheel. I think you'll find it very interesting. And obviously, it can be tied to member satisfaction. Clubs that, our experience is that clubs that have a declining net worth also struggle with member satisfaction and struggle with loyalty. So here's that one you know, financial measure, right? If we were Wall Street guys, this is how we were analyzing individual clubs. This is one of the things that, you know, we don't get paid like Wall Street analysts get paid, but this is one of the things that we would do if we were one of those analysts. What we've done is we've taken if we buy into that this club has an asset value, and that asset value is representative of the investments that have been made in the club over time, and those investments are then the drivers of the capital income coming back into the club, either from our current members or from our you know, new members that are coming in. You have to remember, the balance sheet of a club only grows because you're taking money off of the balance sheet of your members, right? If it's a capital dues or assessment, your members are taking money off of their balance sheet and giving it to the club. If you're a new member, that initiation fee is coming off the balance sheet of the new member and going onto the club. And so you have to prove that you're good stewards of that capital by investing it in the right things. But if we take a look, we look at the capital starved clubs. Let's not worry about the calculation side of it. But those clubs have a return on equity of 5%. Okay, so capital income divided by the total unrestricted net assets in the club. And every club can get that UNA number. Their controller can give you that number in 5 minutes, and we'll talk in a minute about getting that for, like, you know, a 10-year cycle. For the capital rich clubs, that return on equity is 13%. It's almost 3 times as much, but there's something even really more important about the capital starved clubs. We talked about, when you look at industries, you know, a basic materials industry tends to have an ROE of about 6%. By definition, a basic materials industry is a commodity industry. Copper, gold, iron ore, all those kind of things, really basic materials. It's a commodity, literally a commodity. What capital-starved clubs do is they drive down their value proposition, meaning they zero or low, very low initiation fees, very low capital income coming out of their membership over time, and they literally have removed any differentiation of themselves such that they look financially, they literally look like a commodity company. Now, a commodity, a club that looks like a commodity, or join our club because it's the cheapest one to join, which is the definition of a commodity. That's a very bad place for a club to be, right? You want to position. I know everybody on the call knows this, but you want to position your club as having differentiated values over the other clubs. So, we've seen it. Clubs are in challenging areas, and one club drops it, and another club drops it, and another club drops it, and they chase themselves down into this commoditization of clubs, this price war, which is, it never ends well for any of the clubs. And I'm more, I understand how it happens because it's challenging in a tough business environment. But, I think I'd rather take a shot at being the club that says, yeah, everyone else has a zero initiation fee. Ours is $5,000. That's because we recognize the need to reinvest in the club every single year, and our club is going to have a different trajectory because we have the capital income to do that, right? If you have to go to zero to attract those members, I'm not sure those members can frankly afford to be in a club. So it's a very challenging environment, and it's vitally important. Clubs get very complacent about their initiation fees, and it's vitally important to protect that and to grow that over time. So the point is, does your club, does your board monitor unrestricted net assets? I'm going to say that 99.9% of the clubs in the country have never brought that number or highlighted that number into the boardroom, and it's a critical number, and it should be increasing over time. Let's give you two examples of that. This is, I'm going to say, because John Schultz at Carmel is very, very open and honest with us. He's a great friend of ours and has been a great partner, in this venture we've been as part of for 8 years. So he's happy to share his data. This is Carmel's unrestricted net asset number from 2010 to 2015. They've made significant investments in the club. And you can see the asset base of the club has gone up. In fact, it's gone up at a compound annual growth rate of about 8.7%. Very significant. We'll look at where the industry is in a minute. But they've invested very heavily over those 10 years. And in turn, over this period of time, they've, I think, at least more than doubled. I know it's more than doubled their initiation fee, and they've more than doubled their capital income. So they've invested into things that justifies their increasing their initiation fee, and invested into things that allows them to go to their members and say, these are all the things that we're investing in that now need to be maintained, and we want to keep this cycle going, so your capital dues is going up over time as well. And this curve of up and to the right for any business, and I know clubs don't necessarily behave the exact same way, but you still, every entity, whether it's an individual person, right? If you talk to your board members and you told them, you asked them, do you know your net worth and has it been increasing over time? They're going to probably know the answer to that. And they're going to say, yeah, it's important for my net worth to grow up over time. Or your business, yeah, it's important for my net worth of my business to go up over time. Same thing applies to clubs because, you need that growth and investment over time to keep adding member value. So, that's what a capital-rich club looks like. A capital-starved club looks more like this. We have got this sort of slow diminishing decay of the asset base. And it's very simple to understand. You've got a tug of war that's happening on your asset base. You have depreciation on one side and capital income on the other side. If your net available capital is lower than your depreciation, by definition, the asset base of your club is shrinking, right? So at a bare minimum, you have to produce a pile of capital at the end of the year that's at least as high, at least as large as your club's depreciation to make sure that you're you're not decaying, and then ideally you're going up. And obviously by doing significant investments, which often require assessments, those are the significant moves to the balance sheet that cause you to have an upsloping asset value. And it's representative of a club that's focused on value creation. And so that's, I want to make sure we always kind of come back to that theme, right? Clearly this club is investing in value creation. This club is not, and it's a whole bunch of reasons why they're not. But this happens to be a club that we're working with, and they've recognized it. Now they're taking very strategic, long-term paths to start moving this up and to the right, and moving more capital income, recognizing that capital income is the driver to value creation. So it's just that the notion of value creation is driven by capital income, and capital income is driven by value creation. That's a very short way to redefine that wheel that we showed early on, that growth cycle wheel. It's pivotal to having the environment for value creation. We're now gathering a lot of unrestricted net asset data for clubs, and actually I should have had the URL on here. Anyone that wants us to generate a chart for them of their unrestricted net asset and their net worth over time can go to our website, clubbenchmarking.com. I apologize, /TB-upload, not TB. What's the word I'm looking for? I'll look at it. I think it's net worth. I'm going to send it out to Beth, actually, and when she can send it out to everybody on the call. And anybody, it takes your controller 5 minutes, grab your unrestricted net asset value for the last 10 years, plug it on the little page. It's going to give you your compound annual growth rate, and we'll in turn take that and we'll generate a chart for you. But this is about 80 clubs or so, and we plotted their 10-year net worth over time. And this is basically the zero line, this 100, call it zero. So all the clubs that have a squiggly line below that 100, these clubs have a negative growth rate. They're decaying, they're shrinking. The clubs that are above that line have a positive growth rate. They're investing significantly. When we look at the overall industry, and again, with about 100 clubs thus far, the median club has a 1.6% compound annual growth rate. What does that mean? That means their net asset base is growing by 1.6% a year. That's not great when you consider that inflation is probably 2 to 3% a year. So a positive growth rate that's lower than inflation is really still signifying decay to some degree. And so, the top clubs, here's Carmel at about 8.7%, and you've got others that are significantly investing over time. It's not just, these are financial numbers, but what these represent are clubs investing in back in themselves, right? Capital investment. The only way you can have a curve that's above this, we'll call it the break-even line, is by doing enough capital investment that you're investing over and above asset replacement, right? Asset replacement is just table stakes. Something wears out, you got to replace it. To really generate value over time, we're talking about investment over and above asset replacement, right? That's where really the compound annual growth rate comes into play. And let's just look quickly. I took the net worth of a club and divided it by the operating revenue, and we can see the median is about the UNA value of a club. We'll call it about the same, 120%, but for 100% it'd be the same. So if it was a $10 million club and you're right at the median, your net assets would be about 12 million. And you can see about a quarter of the clubs have a net asset base which is less than 75% of the revenue. In fact, you've got probably 20% of clubs, maybe 15% of clubs, where their net asset base is less than half of their revenue. So if it's a $10 million club, their net asset base is something less than 5 million. So these are clubs that are, likely in the decay cycle. And when we take a couple examples, let's just use the chart down below here for the sake of time. These are two 36-hole clubs, okay? Their operating revenue is almost the same, about 10 million and about 11 million. So they're about two $10 million 36-hole clubs. They both have fairly old clubhouses, 50 years, 88 years. One is very capital starved, 3% capital ratio. One is what we'll call it, just on the capital rich side, 14% capital ratio. There's a dues ratio that reflects pretty low satisfaction, but let's not go with that right now. Here's the key. The net worth of this club, meaning the unrestricted net asset value, is $2.6 million. This club is $13.8 million. So this is really important to grasp, because this is the long-term impact of being capital starved year over year over year without the ability to reinvest back into the club, which clearly, if you're not reinvesting back in the club, you cannot, I'm going to say, you cannot by definition be a highly value-oriented club, right? Focus on value creation. You can't be, because it's just, you don't have the environment to do that. But this club is decaying itself down to zero. I mean, this is 25% ratio of net worth to operating revenue, and the fact that this dues ratio is so weak, they're going to be in a path. They probably are in a path. Obviously, I can't say who it is, but they're losing members because they've been so capital starved that not only do they have a very bad balance sheet scenario, but it's gotten to the point where it's hitting their income statement, because at a 38% dues ratio, you're not even going to achieve a break even. You're going to have an operational deficit. So it's a laser focus to be focused on this stuff, such that you don't get in. This club is stuck deeply in this red wheel, and they probably have one bullet. If they can rally enough support with enough core members, they probably have one bullet they can fire. Otherwise, they may become one of those clubs that's picked up by Concert Golf or one of these other clubs. I need to move along here quickly. We'll skip through this. Value creation can mean a whole bunch of different things. It doesn't always have to be $10 million, $5 million, right? You see, there's kind of a little trend with clubs where they're bringing on food trucks. One of those things where it's not going to show up obviously on the asset base, and it's not going to have those ROE kind of calculations. But at the same time, it's one of those quirky things that has an impact. Big investment on interior spaces that have value. Fitness. This is TC of Detroit. They built a big new fitness area and bowling area, big bowling area in Detroit, I suppose. Big investment in culinary. Everyone knows Jeff McFadden at Union League. They frankly have been kind of the poster children for deep, high value investment ongoing, right? This was when they had a bunch of their members who tended to leave in the summer and not use the club because they were all on the shore. What did they do? They went and bought a restaurant on the shore, and now it's for members only. Not only did they increase member value for the members they had, but they had a bunch of prospective members who said, I really would like to join, but, I'm gone all summer. I'm over at the shore. Well, now they've just completely, shorted that one to ground by saying, well, now we've got a place for you to go. And in fact, a lot of those members have come in, or prospective members. They've recently added a golf club, as many people know. So they're kind of off the charts in their ROE, because all this investment they've made drives in greater and greater amounts of capital income. So their ROE is like 25%, which is crazy for someone in the club world. But that's an example of what happens pushed to the extreme. The other end of the extremes, unfortunately, are all too common. And you got to start where you can start. Make that significant investment. In fact, talking about how it impacts culture. I saw Jeff. This is probably a year ago. We were having a conversation, and he said, "I've actually have members coming up to me saying, Jeff, when is our next assessment going to be? Because we know you're going to do something really great with it." I mean, that's crazy for people asking, ready to stroke the check for the assessment, because they've now proven to be good stewards of how they're going to invest that money. So people get excited about it. Yeah, I'm going to write you a check. It's great. So that's what I mean when I say this is cultural, and I think the culture probably lags the investment. Right? You have to sort of prove your stewardship that you're investing things that have high member value, and that over time, brings the culture along, and that brings not just satisfaction but loyalty. And I think loyalty is a deeper affinity for the club than just satisfaction is. I can be satisfied with something but not loyal to it, and loyalty is what really I think is the goal. So just to sort of come close to summing up here, I really do believe that this is a chart, these two red and green charts is one that should be in front of every single board, and they should understand the discussion that we've had here this morning around investment for member value, which drives increased capital income, which enables and drives more investment, right? It's a never-ending cycle that you want to be into. And this is the on-ramp. If you're not in that cycle, this is the on-ramp to get there. And you have to be very strategic and wise about what that first investment is. Make sure it's for a highly visible, high member value area that both current and prospective members will see value. I can't tell you what that, every club needs to decide what that is for themselves. Obviously, it's not a cookie cutter, but it is critically important. And it's interesting. It's good to sort of check off these attributes, because I think it tells you, depending on how strong your check marks are here versus how strong your check marks are in here, I think it tells you how much work you have in front of you to move from one side to the other. Obviously, the deeper and brighter your check marks are here, the more work you have to do, and the more that you really need a strong president and a strong board to help you move in that direction. But I do believe that I am a believer that all boards want to do the right things. They just don't have the right knowledge to help them get on that path. By the way, when every club on here, we talked a little bit about it. You can do it yourself, but take the last 10 years of your unrestricted net assets and just plot it in Excel, or like I told you, I'll send Beth that URL, or probably at the end here, Terry can give us that URL. So just plug them in. It takes 2 seconds. Plug them into a web page, and it's going to give you your chart. It's very telling, because when you bring into a boardroom a net worth chart for the club, and it shows it's going down to the right, it's decreasing, that really gets their attention. We've seen a number of times now where you have all this tactical discussion goes on, and we're in a boardroom, and we flip over that chart, and it stops the discussion dead cold. Because every person on that board understands that declining member equity, declining net worth is bad. And it sort of, shocks them out of the discussion around food and beverage and banquets and things like that, because you realize there ain't enough hamburgers in the world we can sell that's going to change the net worth of the club, right? These are big, bold chess moves that have to be made. So the opportunity for value creation, it does live, it is alive for every club, but it is at an intersection of culture and finance. It's not one, it's not the other, it's both. And it's not automatic, right? You have to, with intent, set up the environment that enables that to occur. Obviously, rising initiation fees and capital income is a gauge for increasing value proposition and confidence, right? For clubs that have that raise their initiation fee, they're having increasing confidence in their club. For clubs that are cutting their initiation fee, they have decreasing confidence in their club, and it's important for that to be understood. Critical focus. Is the club physically growing or shrinking? Focus on the balance sheet. And I know we've all heard that, and it's obviously we all believe it. And I think this net worth path might be the way to get clubs to really start thinking that way, to get boards to start thinking that way. So simply stated, we believe investment precedes success. Why is it? Here's a great example, right? Why is it when Club Corp or Concert Golf or any of these folks buy a club, which is usually a struggling club, why is it that the first thing they do, CCA called it reinvention, Club Corp or Concert Golf called it something else. Why is the very first thing they do is invest several $1 million into the club? because they know, they're business people. They know that that investment is what's going to drive demand, and that demand is what's going to drive the whole business model. So those are two real life for-profit examples of this notion of, you know, investment precedes success. So we'll take for questions. Just your little code word for CMA credits is SEC football. I have Beth to thank for that little password. And you can email that to info@FLCMAA.org, and she'll take care of that for you. With that, I think we'll open it up to Terry and see if we have any questions we might be able to cover.
With apologies for noisy background, we don't have any questions, but I did just post that URL in the chat pane. It's clubbenchmarking.com/net-worth.
Okay, that's great. In fact, I'll go to it. It won't take me there. It won't take me there because I'm on it. There we go. Yeah, so everybody can, let me just show you that page, see what it looks like. Everybody can go there and very simple. Have your controller plug in your UNA for the last 10 years or whatever you have. It's going to give you a compound annual growth rate, and then we can deliver that chart back to you. It's very telling, very, very powerful. So I really suggest everybody do that. With that, I appreciate everybody's time today. I hope it was worthwhile, and we hope to see and speak with you all soon. Thank you.